Good morning and welcome to TOITOI Japan Market Radio, coming to you from Tokyo on March 15, 2026. I'm your host, and this is your daily briefing designed specifically for global investors tracking Japanese markets. Today we're covering equities, the yen, and rates, along with some significant headlines that have moved sentiment overnight. Joining me as always is our portfolio manager focused on Japan. Let's start with the market summary.
Thanks for having me. So for viewers tracking today's session, the Japanese market was actually closed today for a national holiday, so we have no price action to report on the Nikkei 225 or TOPIX. That said, there's been plenty of news flow while the market was dark, and I think it's worth unpacking some of the bigger themes that will likely greet investors when Tokyo reopens tomorrow.
Absolutely. And speaking of news flow, let's dive straight into the top story that's been circulating among institutional desks. Goldman Sachs has cut its near-term price targets for the TOPIX index, and the reason cited is heightened geopolitical concerns. Walk us through what this means.
Sure. So Goldman's move is significant because it's one of the most closely watched sell-side voices on Japan. What they're essentially saying is that the geopolitical risk premium has risen to a level where they believe it warrants a lower valuation for Japanese equities in the near term. While the note doesn't specify exactly which geopolitical tensions are driving this, it's reasonable to assume they're referring to regional risks in Asia or broader global instability that could disrupt trade flows. For Japan, this matters a lot because the economy is export dependent and relies heavily on stable supply chains and open shipping lanes. Any disruption to that framework has direct earnings implications for Japanese corporates, particularly in industrials, autos, and electronics.
Right, and when a major strategist like Goldman cuts targets, it's not just about the call itself but also the signal it sends to other institutional investors. What's your take on how this could affect positioning?
Exactly. These strategist notes often act as a coordination mechanism for asset allocators. If other sell-side firms follow Goldman's lead and start marking down their Japan targets, you could see a wave of tactical selling or at least a pause in inflows from foreign investors. On the equity side, that's clearly a near-term headwind for both the TOPIX and the Nikkei. On the yen, interestingly, the impact could be mixed. Typically, risk-off sentiment supports the yen as a safe haven currency, so even if equities are under pressure, you might see USD, JPY move lower, meaning a stronger yen. And for Japanese government bonds, I'd expect yields to decline as investors rotate into safer assets. That flight to quality dynamic would put downward pressure on 10-year JGB yields.
So in a nutshell, equities face headwinds, the yen could strengthen, and JGB yields likely fall. That's a classic defensive rotation. Now, staying on the theme of market structure, there's another story making the rounds today. The iShares MSCI Japan ETF is apparently capturing what's being described as a once-in-a-generation shift in Japanese stocks. That's a bold phrase. What's driving this?
It is a bold phrase, and I think it reflects something real. What we're seeing in Japan is a structural transformation in how companies are managed and valued. This isn't cyclical noise. We're talking about improvements in corporate governance, better capital allocation, higher dividend payouts, more share buybacks, and a general shift toward shareholder-friendly policies. The Tokyo Stock Exchange's push to get companies to trade above book value has been a catalyst, and you're seeing real changes at the firm level. The iShares MSCI Japan ETF, which is one of the largest passive vehicles tracking Japanese equities, is naturally capturing these flows as investors recognize this shift.
And for global investors who are considering Japan exposure, what does this mean in practical terms? Are we talking about sustained inflows, and does that change the risk-return profile?
I think it does. If this shift is durable, and I believe it is, then you could see continued passive inflows into Japan tracking ETFs, which would provide structural support for the broad indices. The key question is whether this is purely flow-driven or whether it's backed by genuine improvement in fundamentals like return on equity and earnings growth. Early indications suggest it's the latter, which is encouraging. On the yen side, sustained foreign investment in Japanese equities could modestly support the currency through portfolio rebalancing and hedging flows, though the magnitude would depend on how large these flows are relative to other capital movements. For JGB yields, the impact is probably limited, but if the equity shift reflects confidence in Japan's growth outlook, it could marginally support longer duration yields in a risk-on environment.
That's a helpful frame. Now, shifting gears to commodities and energy, there's a third headline that has implications for Japan. Oil prices are positioned for further gains as escalating conflict in the Middle East threatens regional export facilities. Given Japan's energy dependence, this is obviously a critical issue. Break down the impact for us.
This is a big one. Japan imports roughly 85% of its energy needs, and the Middle East supplies around 40% of its crude oil and a significant portion of its liquefied natural gas. So any sustained disruption to Middle Eastern exports would directly increase Japan's energy import costs, which pressures both corporate profit margins and the trade balance. On the equity side, higher crude oil prices elevate input costs for manufacturers, utilities, chemicals, steel, and shipping companies. That's a downside risk for the Nikkei and TOPIX, and it would offset any competitiveness gains that Japanese exporters might get from a weaker yen.
And on the yen itself, how does rising oil play out? Oil is priced in dollars, so does that automatically weaken the yen?
Generally, yes. Rising oil costs mean Japan has to pay more dollars for energy imports, which increases demand for USD and can weaken the yen. There's also a policy dimension. If energy costs are rising, the Bank of Japan may be even more cautious about tightening policy, which would keep the yen under pressure. That said, in the very short term, if the Middle East situation escalates sharply, you could see a brief risk-off move that supports the yen as a safe haven. But I think the dominant medium-term force would be yen weakness driven by higher energy import costs. For JGB yields, the initial reaction would likely be a decline as investors seek safety, but if higher oil prices feed through to inflation, that could eventually put upward pressure on yields. Right now, though, I think the flight to safety bid would dominate.
So for investors, the key variable to watch is whether crude oil sustains above a certain level. What's the threshold that would materially impact earnings?
A sustained move above $80 per barrel would be significant. At that level, you'd start to see material revisions to corporate earnings forecasts, particularly for energy-intensive sectors. I'd also be watching whether Japanese utilities start hedging more aggressively and whether the government considers any strategic petroleum reserve releases. Those would be signs that policymakers are taking the risk seriously.
Understood. So to bring this all together, we've got three major themes today. First, Goldman Sachs cutting TOPIX targets on geopolitical concerns, which signals potential near-term headwinds for Japanese equities and could trigger defensive positioning. Second, a structural shift in Japanese equities captured by passive flows into the iShares MSCI Japan ETF, which reflects improving corporate governance and capital allocation. And third, rising oil prices driven by Middle East conflict, which poses a direct risk to Japan's energy import costs and corporate margins. How should global investors synthesize all of this?
I think the key is to recognize that Japan is facing both structural tailwinds and cyclical headwinds right now. The corporate governance story is real and it's not going away. That's a medium to long-term positive for Japanese equities. But in the near term, geopolitical risks and energy price shocks are creating volatility and uncertainty, and that's going to weigh on sentiment. For investors with existing Japan exposure, I'd be watching whether other strategists follow Goldman's lead, because consensus downgrades often precede broader portfolio rebalancing. I'd also be monitoring crude oil closely, because sustained elevation in energy costs could force earnings revisions across the board. On the yen, the direction is going to depend on which force dominates: risk-off safe haven flows or energy-driven weakness. Right now, I'd lean toward the latter in the medium term.
That's a very clear summary. And just to underscore, nothing we've discussed today constitutes financial advice or a recommendation to buy or sell any specific security. We're here to provide context and analysis for investors who are already tracking Japan or considering exposure. If you're a global investor following Japanese markets, consider subscribing to TOITOI Japan Market Radio for daily updates. Thanks for joining us today.
Thanks for having me.